Are mortgage rates about to take a turn for the worse? Should you lock in your rate now, or could there be a window for lower rates just ahead? Well, if you're thinking about buying, selling, or investing in real estate, you need to know what's happening in the market because this week's data sent some really mixed signals. Hi there, I'm Mike Peters with MPRE Boise, powered by NextHome Treasure Valley, and I break down weekly mortgage rate updates so that you can make informed decisions in Boise, Meridian, Eagle, Nampa, Caldwell, Kuna, Star, Middleton, and Emmett. But before we dive in, please hit that subscribe button below, hit the notification bell so that you're constantly in tune with the videos that I do come up with, and give me a like before we move forward if you really enjoy this content. Also, if you know of somebody that might find this information useful, please share this video with them so that you never miss an update. So let's talk about where we started and where we ended this week. Well, we started the week with rates hovering around 6.72%, showing a slight decrease from the previous week, which was a welcome sight for some buyers and refinancers alike. However, as we moved into Tuesday, rates began starting to tick back up again, climbing to 6.79% as the market adjusted to shifting economic indicators. By Wednesday, we saw another small rate increase, with them moving up to 6.82%, but Thursday brought some relief with a minor dip to 6.78%. But by the time today rolled around, Friday, rates rose and landed at 6.81%, making a notable increase to close out the week. So if you're watching rates closely, this week was a reminder of how quickly they can shift. While the beginning of the week hinted at a slight cooling trend, the end of the week saw a rate rise again, highlighting the volatility in the mortgage market. Understanding why these fluctuations happened is key to making informed decisions. So let's break down what drove this movement. This week, mortgage rates were influenced by a combination of inflation reports, job market data, and stock market volatility. One of the biggest imports to impact rates was the Consumer Price Index, or CPI, which was released on Wednesday. The data showed that inflation cooled slightly in February, which should have been good news for mortgage interest rates. However, January's inflation number was revised higher, of course, and some underlying components of the CPI suggested that inflation might be more persistent than expected. This led to uncertainty in the bond market, which kept mortgage rates from making any significant downward move. And then on Thursday, we got the Producer Price Index, or PPI, which measures inflation at the wholesale level. This report showed us some mixed results. Some areas came in lower than expected, but others signaled price pressures could remain, which further complicated the rate outlook. Markets reacted cautiously, and while bonds initially saw some improvement, they later pulled back, keeping rates from making any real progress downward. Beyond inflation, the job market continues to play a significant role in movements. Jobless claims this week were lower than expected, meaning fewer people filed for unemployment. Normally, a strong labor market is a positive sign, but in a high interest rate environment, it gives the Federal Reserve less incentive to cut rates anytime soon. The Fed has repeatedly stated that they want to see the labor market cooling before they make any moves, and so far, that hasn't happened. Stock market volatility also played a role this week. We saw a strong correlation between stock market declines and temporary dips in mortgage interest rates. As stocks struggled, investors moved into bonds, which helped rates stabilize midweek. However, once the stock market regained strength, mortgage rates rose once again, closing out the week higher. So what's coming next? Should you lock in or should you wait? Well, next week, all eyes will be on the Federal Reserve's policy meeting happening on March 18th and 19th. While the Fed is not expected to cut the rate, the market will be watching closely for any indications about future policy shifts. And one key piece of information that will be coming out this meeting is a summary of economic projections, or SEP. Now, this document outlines the Fed's outlook on economic growth, unemployment, and inflation. And most importantly, it gives us insight onto how many rate cuts the Fed is expected to make in 2025. Well, if the SEP suggests that the Fed is taking a more cautious approach and pushing rate cuts further into the year, we could see rates remain elevated. But on the flip side, if the Fed signals more optimism about inflation cooling down, we could see the rates begin to ease. So, should you wait for the SEP to come out before locking in your rate? Well, that depends on your risk tolerance. If you're someone who prefers certainty, locking in now would be a safer bet since we know that rates have been trending up and the Fed isn't planning a cut just yet. However, if you can afford to wait and are comfortable with some volatility, watching how the Fed reacts next week could give you a better idea of where rates are headed in the months to come. If the SEP suggests more aggressive cuts later in the year, waiting could work in your favor. But if the Fed takes a more cautious approach, rates could stay elevated, making today's rates look more attractive in hindsight. So, I guess, what do we know? Well, the mortgage market remains unpredictable, but staying informed is the best way to make smart financial decisions. Next week's Fed meeting will be a major factor in shaping the rate outlook moving forward. So what do you think? Will the Fed hint at rate cuts, or will they hold them firm? Drop your comments and let me know your thoughts. And remember, hit that like button if you liked what you saw, hit the subscribe button, and hit the notification bell so that you're constantly in tune with these videos as they pop up. And feel free to share this video with anybody that you know so that they can stay ahead of the market as well. And if you're thinking about buying or selling in the greater Boise, Idaho area, I can help. Or if you're also moving to Oregon, Washington, California, Nevada, Arizona, Tennessee, or Florida, I can connect you with a trusted loan officer in your area. Reach out anytime. Well, thanks again for watching, everybody. And of course, if you have any further questions, please feel free to reach out to me. I'm more than happy to answer any questions that you may have. And thanks for watching. I look forward to seeing you for another mortgage rate update next week. God bless. And I also look forward to the day that I call you my neighbor.